how a holding company can help you build and protect your wealth. Have you ever wondered how much of your wealth could be lost to tax when you pass it to the next generation? For business owners and investors, one of the most effective tools for building, protecting, and transferring wealth is something called a holding company. In this video, we'll break down what a holding company is, how it works, the tax advantages it offers, and how it can simplify estate planning and protect your asset. What is a holding company? A holding company is a corporation created to own and manage investments, things like real estate, stocks, or shares in other businesses. Unlike your operating company, which earns revenue and takes on day-to-day risks, a holding company simply holds assets. Its purpose is to manage and protect wealth efficiently, while reducing taxes and exposure to business risk. How it works. Let's say you own a profitable business. Over the years, you've built up savings inside that company. Instead of leaving those profits there, where they're exposed to risk, you transfer them to a holding company. Once the money is inside the holding company, you can invest it however you like, in real estate, market portfolios, or even life insurance policy, while deferring personal income tax. Your profits continue to grow inside the company, taxed at the lower corporate rate instead of your higher personal rate. The longer your money stays in, the more efficiently it compounds. The major benefits: tax deferral. Profits moved from your business to your holding company are taxed less. You only pay personal tax when you eventually withdraw funds, giving your investments more time to grow. 2. Asset protection. If your operating company is ever sued or faces financial problems, the assets held in your holding company are separated and protected. Creditors can't access what's stored there. Easier estate planning. A holding company makes it much simpler to pass on wealth. Instead of transferring multiple properties, shares, or accounts individually, everything sits under one structure. Your beneficiaries can receive assets through the company, often with far less tax. Tax efficiency in action. Here's a simple example. You own a business with $2 million in profit. You move that money into your holding company. The transfer can often be done tax-free between connected corporations. Now, those funds can be invested and taxed at the corporate rate, typically much lower than your personal rate. That means more of your money stays invested and keeps compounding instead of being lost to taxes right away. This approach also helps you control when you pay personal taxes, allowing you to plan withdrawals in the most efficient way. Using a holding company for estate planning. A holding company isn't just about saving taxes now, it's about planning for the future. When you pass away, your assets usually face capital gains tax. But with a holding company, you can organize things in advance through what's called an estate. Here's how it works. You freeze the current value of your company, say it's worth $1 million, and exchange your ownership for preferred shares equal to that value. Then, new common shares, capturing all future growth, go to your heirs or to a family trust. This locks in your taxable amount today and shifts future appreciation to your family, reducing taxes later and ensuring a smoother wealth transfer. Other key advantages. Capital Dividend Account (CDA). When a holding company owns life insurance policies, the tax-free death benefit can flow into what's called a capital dividend account. From there, the funds can be distributed to shareholders, your heirs, completely tax-free. This is one of the most efficient ways to pass on wealth. Simplified estate transfers. Because everything is under one corporate structure, your executor won't need to sell properties or liquidate investments to pay taxes. The holding company continues to own the assets, ensuring stability and privacy. Creditor protection. If someone sues your operating company, they can't touch the assets held in your holding company. That separation acts as a financial firewall between your business and your wealth. Common mistakes to avoid. Not separating assets. If you leave extra cash and investments inside your operating company, you risk losing access to major tax exemptions when you sell it. Ignoring tax rules. Improperly transferring assets between family members or companies can trigger unexpected taxes. Always plan carefully with a qualified tax professional. Setting it up incorrectly. Yes, you can incorporate a company yourself, but mistakes in setup can cost you thousands later, or even disqualify you from the benefits. Always use a corporate lawyer who specializes in business and estate structures. Is a holding company right for you? If you're a business owner, real estate investor, or professional earning significant income, a holding company can help you. Save on taxes, protect your assets, grow your wealth faster, simplify your estate. It's especially valuable if you want to build intergenerational wealth, keeping more of what you've worked for and passing it on efficiently. If you'd like to learn how a holding company could fit into your own wealth strategy, visit emeraldwealthservices.com. Our team can help you understand how to combine smart corporate structures with life insurance-based strategies to protect and grow your legacy. If this video helped you, please like, share, and subscribe for more practical wealth building content. Thanks for watching. And remember, true wealth isn't just about making money. It's about keeping it, protecting it,